Good morning, ladies and gentlemen, and welcome to the Galliford Holdings PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. And before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from Galliford Holdings. Bill, good morning, sir.
Morning. Thank you, Jake. Morning, everybody. Thank you for joining. I'm Bill Hocking, Chief Exec, and I'm here with Chris Hampson, our new CFO, and you'll hear from Chris in a minute. So I'll start off with the highlights, and then Chris will take us through the numbers in a bit more detail, then I'll do a bit of an update on the strategy. So here are the highlights for the year. We've had a really, really good year, everyone. Revenue, £1.8 billion, which is up 27% on the previous year. There are some reasons for that revenue growth, which I'll come back to in a minute. As a result of that, we've raised our operating margins to 2.5%, en route to our original target of 3% in 2026 and our new target of 4% in 2030. But just for everyone's clarity, we are still aiming at 3% in 2026 as a waymark along the way to 4% in 30. So really good performance on PBT level, £32.7 million, up 40% in the previous year, and a really good dividend of 15.5p for the whole year, up 48% in the previous year. So lots of happy shareholders out there. Chris will talk about cash and so on, and our new £10 million share buyback, which we announced last week. The order book is in really good state at £3.8 billion, up £100 million in the previous period last year. And again, I'll go into that in a bit more detail later on in the presentation. Just going back to that £1.8 billion revenue number, we had good underlying revenue growth in the year, and that was augmented by two things. Firstly, if you cast your mind back into 2022, the mini budget and sort of a hiatus that followed that, and the inflationary spike that followed that. Through that period, we were very, very disciplined in not taking on work until we knew that we either had protection against inflation or could properly price it and things like that. So we held off, and that produced a bit of a hiatus in awards in that period. And so part of the growth over and above the good underlying growth last year was that work coming through. Because it all sort of fell into place early 23 and it's washing through now. So that was one reason. Another reason was a really good year in AMP7 in water. So we'll go into water in a bit more detail later on in the presentation, but obviously, as you've all seen, there's an awful lot going on in water at the moment. So a really, really good start to our 2030 strategy, really strong year, and over to Chris for a bit more detail on the numbers. Thanks, Chris.
Thank you, Bill, and it's really nice to be here. I've had a great welcome from everyone to the company. So let me take you into the numbers in a little bit more detail. We'll start with the segmental analysis. So, as Bill said, really strong year of revenue growth, up 27% to 1.773 billion. So really good, strong growth. Building grew by 17.7% and infrastructure by 38.8% for those reasons that Bill just pointed out, strong underlying growth and those two tailwinds helping us along. Investments grew strongly. We completed the financial close of our first PRS scheme in Cardiff, so that was very helpful on the investment revenue as well. Moving to profits, you can see that we grew profits in line, each of the divisions growing, the two big divisions, building infrastructure, growing their profits in line with their revenues. Investments moved backwards slightly from plus 1.4 to minus 1. There was a one-time 3.6 million JV disposal in the prior year. Our investments portfolio earns interest, has an annuity income of about 3.8 million. It is worth pointing out that falls into the interest line, so below operating profit. But if you add that back in, the investments makes profit overall. Central overheads slightly up in line with revenue. So in terms of margins, I think worth pointing out a really strong performance from building, moving its performance forward 23 basis points. Infrastructure held it flat, It made good gains last year, held them this year. There were a couple of projects that were delayed, which held the margin back from improving. But overall, the group margins moved forward by 13 basis points, which is a good step forward. So from my point of view, as a relatively new starter, it's worth saying that we grew revenues by 27%, profits followed, and margin accretion. The margin accretion comes from 2 points: good operational cost control, and also from our robust risk framework and contract selection model. With Bill's and the team have been very tight on that. I'm sure you've heard about it before, but just fundamentally, we choose where to play and where not to play, where we understand the risks and where we can manage and mitigate those risks and price for those risks. And if you do that, then it comes down to execution risk, and the team have executed brilliantly, as you can see, to drive revenues and margins forward. Worth just touching on the left-hand side, exceptional costs in the period of 2.6 million. Those exceptional costs we reported at the half year relating to the implementation of our digital strategy, the ERP system that we've implemented. That is now complete. There were no further exceptional costs in H2, and we expect no further exceptional costs relating to that investment going forward. Pleased to say we've reported our numbers on the ERP system, so that's always a good measure of success. And we're now moving forward into the optimization phase of that, where we try and sweat that asset for what it's worth. I would just point out, not on this slide, but our tax rate 14.6%. We had some one-time deferred tax asset gains in the year. We expect the tax rate to normalise going forwards. And we also had we treated as exceptional a £9.6 million corporation tax refund relating to 2019. We had confirmation of that alongside associated interest of 0.8 million. We had confirmation of that in June, so we booked that as an exceptional credit in June. The cash was received during the month of August. So just to be clear, we booked the gain in the period as exceptional, but the cash was received in the 24-25 financial year. If I move on to the next slide, you will see effectively two bridges on the right. I will just pick the bones out of that. The top one is the profit chart. You can see last year we had the JV gain that I mentioned earlier. So if you take that, the ongoing profit in 2023 was about £18 million. We grew £9 million from the volume flow through at the prior year margins. The operational leverage delivered another 2.2 million. So effectively an extra, just slightly more than 10% extra profit in the year. And then we completed the acquisition of AVRS in Q4 of 2023. That was profit and margin accretive in the period, and that drove the operating margin up to £29.6 million. If you move to the chart below, what's really pleasing to see is that we turned that profit of 29.6 million into cash from operating activities of 33 million. So more than pound for pound cash conversion into operating profits. So again, just to repeat that point, we've grown revenues, we've grown profits, we've grown margins, and we've turned that into cash in the period. As a result of tight cash management, our month-end cash, average month-end cash, has risen from 135 million to 155 million. That's roughly a 15%. And that tight cash management can be seen in the working capital movement of plus 7 million. That comes from 2 points, really, that tight monthly focus on this, which is absolutely critical. And secondly, as you grow, you get some payments on account, and that helps drive working capital forward. So 7 million pounds there. 3 million pounds net of interest and tax. Stronger cash balances in this strong high interest environment allows us to generate interest returns. So that netted 3 million pounds, which in our view effectively funded the 2.6 million pounds for the digital ERP implementation in the period. So those two net to zero. Then we returned 29 million pounds. So we generated 30 million pounds of profit, 33 million pounds of operating cash, and we returned 29 million pounds. The 29 million pounds is broadly made up of the normal dividends, so a growing dividend in the period on the growing profits. You'll remember we announced a policy last year of 1.8 times cover, so that's the dividend in there. So we paid that dividend. We also paid a 12 million pound special dividend on the 6th of October 2023. In relation to a claim we'd successfully received. And then during the period, we completed the 2022 share buyback of 15 million, about 5 million pounds in the period. So that adds up to 29 million. To the right, we spent a couple of £1 million on share purchases for employee benefit trusts and so on. And then there's a net of the £4 million cash consideration of AVRS, offset £2 million for the disposal of rock and alluvium. That moved the overall year-end cash from 220 million to 227 million. Worth pointing out just a couple of points. Also, we have no bank debt at all. So clear of any bank debt, and we have no pension liabilities. So in reality, we show a net cash balance on the balance sheet, and we're in a great position. We have a PPP portfolio. I mentioned the investment annuity income earlier. That's we have an asset of 41.8 million. It's a very liquid asset. If we needed to dispose of it, we could, but it generates roughly 10%. So it's very strong for us, and that's where we keep it. However, we do return all of that 3.8 million to shareholders each year. So our dividend is broadly made up of the annuity income from the PPP portfolio, plus about half of our operating profits. I think just the other point worth making, really, in a year where we've implemented an ERP system, which is always a very big project, we have managed to continue to pay our suppliers on time. 96% of invoices paid within 60 days and 26 average days to pay. The strong balance sheet we have is really crucial. It's crucial to our customers. I'm sure Bill will talk about, or we'll have a question at some point on ISG and so on, but it's very critical to our customers that they know they have a supplier who can deliver the project on time. And it's also very critical to our supply chain. Suppliers want to work for customers who will pay them, and I think we can demonstrate repetitively that we do pay them, and we pay them on time and in full. So a really strong cash message, a really strong balance sheet. We've got the ERP system in place now. That is working. That's a really big foundation block for us to go forward towards our 2030 targets of 2.2 billion of revenue and 4% divisional operating margin. In terms of capital allocation, I guess really 2 or 3 points, very quick points to make here. One, as a new CFO, I'm going to confirm that we are not changing our capital allocation policy as we go forwards to 2030. So no big change there, you'll be pleased to know. And I think as you look across the 3 boxes below, we have that sustainable dividend policy, 1.8 times cover, which is very strong in the industry. And we also allocate in 2 other ways. We invest in businesses. We've bought 4 businesses over the last few years, generating north of 120 million pounds of revenue per year. Those are in our specialist services businesses, the higher margin businesses that we're moving towards, and Bill will tell you more about that. And then where we have excess cash, and just a reminder of our definition of excess cash, we expect to have average month-end cash in the tram lines of 8 to 12% of annual revenues, at 9% at year end. But where we have excess cash, we will return that. And so worth pointing out that we have just announced a second share buyback of £10 million maximum. That £10 million broadly equates to the corporation tax refund that I referenced earlier. And so in the last 3 years, we will have done 2 share buybacks and 1 special dividend that I also mentioned earlier. So you have a clear picture of our capital allocation model. We prefer to invest it for growth where we can, but where we can't, and where we have excess cash, we will return it either as a share buyback or as a special dividend. So a very clear message on capital allocation. And we're saying we're going to be as robust about our capital allocation as we are about our contract selection model. So I think those will be the key points I'd make. And I think, Bill, at that point, back to you to talk about how the strategy and the engine works.
Great. Thank you, Chris. Okay, everyone. So on the left-hand side here is the philosophy of how we run the business. So we start in the middle there with 4,200 really good people, and on the left, starting from the left, we embed a culture and very strong processes around risk awareness. So high degree of selectivity of what we do and what we don't do, as Chris said earlier on, the clients we work for, the ones we don't work for, all that sort of thing. Over time, that becomes a culture, as I've said, and actually just to reinforce that the incentive mechanism in Galliford Try do not include revenue. So our incentives are about profit, they're about cash, they're about ESG measures. There's not a single revenue incentive in Galliford Try because it can drive the wrong behaviors. So that process, that culture then leads to a very high quality order book. with sensible clients, sensible terms and conditions, in the right geography, with the right people, with the right supply chain, etc., etc. And what that means is that we deliver our projects consistently and predictably, and we make the profits that we expect to make and generate the cash we expect to generate. That strengthens our already strong balance sheet, and so the wheel turns. And if you go back to the sort of link between selectivity and a balance sheet, when you've got a very strong balance sheet and a very good order book, you don't need to go scrabbling around taking on work that you're going to regret later. And that's a really, really important thing to bear in mind for any construction company. Having the discipline not to take on work you're going to regret later, and be very, very good at that. Then, of course, on the right-hand side, I've talked about the top bit, but then we have very robust commercial control reporting through the tendency of our projects. The strategy through 2030 is simplistically made up of three main strands on the left there. The first one is to grow our big revenue generators: building, infrastructure, and environment. So building is schools and defence establishments and health establishments, prisons, things like that, and infrastructure is mainly highways at the moment, and environment is mainly water and wastewater, which of course is very topical at the moment. I'm sure we'll come back to that later. So the simple plan is to grow revenue and margin in the three core businesses through to 2030, and then simultaneous with that, grow our specialist businesses in higher margin adjacent markets. So we have 8 specialist businesses now. We have 4 in the water industry that we've acquired over the last couple of years, and all of those are either in capital maintenance and asset optimization in the water industry, or in manufacture of pretty high-tech bits of kit for the water industry. The more building-oriented ones are in FM. They're in security, high-tech aspects of security, and in fire-related issues like fire doors and facade remedials and things like that. And so these businesses are fairly small at the moment. We've been incubating them over the last few years. They're going to grow up to critical mass over the period, and at the so further out towards the back end of the strategy period, these businesses will be coming of age and producing those higher margins to augment the margins in the big revenue generating businesses. The other plank is to re-enter the affordable homes market. So when we sold our house building operations back in 2020, there was a restrictive covenant on affordable homes. That covenant came to an end last year, and so we're going back into this market because it's a very big and it's a very attractive market. Our definition of affordable homes, just to be perfectly clear, is that it's sort of mid-rise blocks of flats for councils and for residential providers and so on. It's not houses per se, so that's really important to understand that. So this isn't a quick fix. Obviously, we need to re-establish ourselves. The construction side of it we have in spades, but we've got a newish team now that's re-establishing our relationships with our prospective clients, getting onto frameworks. We've won 4 good framework, or positions on 4 good frameworks now, and we have to start to bid and win on those frameworks, which means the revenues through the stream will also be fairly back-end loaded. It's, if you want a job today, then it's designed for 6 months or so, and then build it is going to take a further 18 months, 2 years. So it is a few years before we start to see revenues start to come through the affordable homes stream. Then when you put all that together, we cover the whole country. We have offices from Inverness to Plymouth and all points in between. So we can leverage that geography, that enormous framework presence through all our public sector, regulated sector and private sector clients, and we can sell and cross-sell more Galliford Try services to those clients. Excuse me. And all that, of course, then continues to generate those shareholder returns. The same strategy in a bit more detail, just about what we really concentrate on. So if I start on the top left there, we spend a huge amount of time on people, making sure that we retain our 4,200 good people and we attract more good people to the company to sustain our growth. We take on about 150 young people every year. Chris and I actually went to the welcoming ceremony the other day, and it's a really, really good day out. About half graduates and half trainees and apprentices. And as I say to anyone who listens, it's my favorite day of the year. The energy and the enthusiasm in that room is tangible, and it really, for me anyway, I'm not looking to patronize anybody, it restores your faith in young people. That we've got some absolutely brilliant young people coming through, and of course we do that every year, and these people are coming through the business and doing really well. Huge focus on health and safety, as you'd expect from any responsible construction company. And our AFR, accident frequency rate, is down at 0.04, which is less than half of last year's, and certainly in the top few in the construction industry. But nevertheless, we'll never be happy until that is zero, and we work very, very hard to make that zero. On the right-hand side there, everything we do, we try to do in a responsible manner. So we've got our carbon targets, scope 1 and 2 through to 2030, so net zero in 2030. To be fair, that's the easier of the targets. The big ones, of course, are embedded carbon, mainly in steel and concrete and things like that. And our target for net zero there is 2045. So we spend a lot of time on that. And actually, when you go back to what's good for your business in terms of ESG, actually, when you look at driving carbon out of projects, you're driving cost out, you're driving program out, you're driving quantities of materials out. So it's a good driver of efficiency as well. And then, of course, in the communities in which we operate, we employ local people as best we can. We procure goods and services through the local companies as best we can. And that's really important to us and to our clients. On the bottom right-hand side there, we look to improve the quality of what we deliver through using modern methods of construction, more digital tools, so we can design a building in virtual reality and build it half a dozen times in virtual reality before we go and do it in anger. And that means that we do it right first time. We spend less time and money on rework and things like that, and the quality is better. We do more construction in factories now, of course, and bolt them together on sites, which also adds to that. We've got a good supply chain. We treat our supply chain well, as Chris said. We pay them on the button, and we've got an initiative called Advantage Through Alignment, where they can get access to our training, to our pipeline, all those sorts of things. So we try to help our supply chain. And of course, having a really good supply chain is important, because a high degree of what we do is delivered through the supply chain. And as Chris said, a strong balance sheet is very, very important to our clients and to our supply chain, of course, to our people as we go through this. Excuse me. So that's it. And when we get all that together, of course, we continue that nice trend of growing revenues and profits through the business. So here are just a few of the drivers of revenue growth. Obviously, apart from the slide, all you've got to do is drive around the country looking around, and you can see the extent of the issue. So a huge amount of the infrastructure in this country is old, and it's struggling to maintain its use under the pressure of growing population, a lot of change in climate change, intensity of rainfall, and all these things making some of what we built in the past really no longer fit for purpose. And the good thing for us is that all the sectors we're in address this issue. So those are the drivers of revenue growth, as well as, of course, for us, expansion into adjacent markets, which I explained a minute ago. Drivers of margin growth, the most important two there on the left-hand side. I've discussed those already, I suppose. Clients, I think one thing that the market still misses in the construction industry, or the listed construction industry anyway, is that clients have changed their attitude to procurement significantly over the last sort of 4 or 5 years now. The construction playbook really started to change this in some anger. It was produced in 2020. We and all of our competitors would have been consulted, of course. And the playbook basically just moves the onus on procurement from the big public sector clients from price to quality, essentially. So we will now work based predominantly on quality now, and by quality we mean the quality of our people, the quality of our balance sheet, the quality of our reputation, our specific proposals, our carbon credentials, our safety credentials. All of those things come into the quality aspect, and then commercial will be an element of price and an element again of supply chain, payment terms, balance sheet, etc., etc. And when you marry that attitude to the attitude of all the tier ones, in my view now, where all of them are being far more selective about what we do and not doing silly things, that means that the whole industry is moving in the right direction. And that's exactly what we want. So those two left-hand boxes, I think, are the main driver. And then that's augmented by the things I spoke a little bit about: off-site construction, modern methods of construction, digital tools, things like that. That'll help us to drive margin growth. Then on the right-hand side there, we've got our higher margin businesses being margin accretive at the back end of the strategy period. And as the business grows, of course, our overhead leverage gets better. So here's a slide that just shows how we win work. On the right-hand side there, you see a typical example. This is a real example, actually, of a client's scoring criteria. So that's the sort of thing that they look at in terms of quality. And we regularly now win work from the most expensive price because we're the best on quality. And so it is working. On the left-hand side there, you can see that 99% of everything we do is procured through some sort of negotiated position. So in the white, the 43%, that's all in building, public sector building. And what happens there is when you're on a framework, there's either some sort of quality-driven mini competition between typically two of the companies in the framework. So it's not a commercial competition. Or in some points, it's just a direct award. It's just, we'd like you to build the school, please. Let's negotiate the price and get on with it. So in that environment, there is no competition. You build up the design, you build up the price for the scheme, which includes, of course, allowances for risk and inflation and markup and all those things. And then in that sector, it becomes a lump sum fixed price at that point, and we're very happy with that. In the grey, it's just pure negotiated when clients phone us up and just say, "Can we build this for us, please?" We negotiate the price, we get on with it. And then in the red, that's all in the water industry and the highways industry. Those are target cost reimbursable projects. So again, in water, once you're onto a framework, you typically have a geographical patch and you do all of the work in that patch. There is no competition. The client pays us to design the schemes. We build up the target price. It's slightly different because it is a target price. Again, it includes inflation and risk and all those things. And then when you go to build that scheme, a water or wastewater treatment plant, you get paid your actual cost plus your fee against the target. And if you bring the project in below the target, you share the gains. And if you bring the target in above, the project in above the target, you share the pain. So it's a very good set of terms and conditions in terms of making sure that people work together to mitigate issues that might arise and keep the project below the target price. And even if you go above the target price, it dilutes your margins as opposed to producing a loss-making project. So it's a very good way of working. And that's all of our work in water and in infrastructure is done on that basis. So the order book, £3.8 billion, 100 million pounds up on last year, and you can see where it is on the left-hand side there. Typically 90-10 for round figures in terms of public and regulated versus private. And the private sector clients we work for are all clients we've worked for a long time and have sensible terms and conditions and things like that. And that's why we work for them. And you see there, we came into this year, so it's end of June numbers, with 92% secured and 70% already secured for the following year. And I see there's some questions which I'll come back to on that. So really good position in the order book and everything in there, high quality work that we can execute with a high degree of confidence every day of the week. So here's just a sort of visual representation of some of the frameworks we have. We've got, every framework we want to be on, we are on pretty much. And you can see that gives us great visibility for donkey's years out into the future. And often, of course, these frameworks are renewed as they go. That's the lighter green color. And we have a high success rate in winning positions on new frameworks as we go through. If you take the second one down, environment, there you can see AMP7 and AMP8, and the SR21 is the Scottish equivalent. And on that slide, you just see two bars going out to 2030. Well, that probably goes out to 2035 in the first place. But when you look behind those, this is what we've actually got in water. So we work for every single of the major water companies. We've got 54 live frameworks. Some of them will be AMP7, which will roll off over the next few years while AMP8 ramps up, of course. 21 of them in the big design and build frameworks. But going back to those specialist business I spoke about and some of our acquisitions, we're establishing a really good footprint in the capital maintenance asset optimization side of it, which is in the white there, and in the water technologies, the high-tech bits of kit we sell into the water industry in the grey. So we're making good progress in establishing our presence in these adjacent markets, higher margin adjacent markets that we want to expand into. And that sort of picture sits behind lots of those other green bars you see there as well. Just a comment on ESG here. So I've just picked a few of our ESG measures, but the main point, everyone, is that our ESG measures are sewn through the fabric of the business. We do them whether we had to report them or not. It makes no difference. All of our measures help us be a better business, help us be a greener, more efficient, more inclusive employer, all of those sorts of things. And that, of course, good people want to work for good, inclusive, green, responsible companies. So I'll pick out a few of these. 93% of our cars, we've got about 2,000 company cars now. And a few years ago, we decided that we'd only buy or lease pure electric or plug-in hybrids from that time. And so as the leases, of course, are renewed, all the cars coming out of the fleet are very low carbon. And I think our average carbon per kilometer is down to something like 15 grams, which is very, very good. So that's just a good example of how you can take a fairly straightforward decision, really, and drive carbon out of the business. Accident frequency rate, I spoke about safety. So that 0.04 is very good compared to the industry. But as I said, we will not be happy until that's zero, and we work very hard to make that zero. We do a staff survey every year, and very pleased that 87% of our employees are strong advocates of the business, which is really important. And I talked about all those young people. Last year, we were number 1 for graduates and number 2 for apprentices. This year, we're number 1 for apprentices and number 2 for graduates. So that's fine. I'll take either of those. So those are just a snapshot. In the appendix to our main presentation, there's a much fuller list of all the ESG measures that we measure ourselves against. So in summary, everyone, before we move on to questions, we're in very, very good shape. We had a cracking year last year. We've had a really good start to this year. Typically, as you come into a year with a political change or a new government, we'll see a bit of a hiatus. This year, to be fair, we've seen absolutely nothing. So it was helped by a fairly short process in the first place, of course. But often a new government will come in and then just put their foot in the ball for a while and decide where to spend the money. We've seen none of that so far. Certainly in terms of justice, in terms of education and defence, it's just been business as usual. Just get on with it. So that's been really good to see. And the other thing where we've had a really good start this year is we often see a bit of a transition through the AMPs in water, and we've not really seen that yet. There's a bit of time yet to go, but so far so good. So really good position, everyone. Great bunch of people, great order book, great balance sheet, and a very, very good outlook. So thank you. That concludes the summary.
Perfect. Bill, Chris, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Bill, Chris, as you can see there, we have received a number of questions throughout your presentation this morning. Thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so. And if I pick up from you at the end, that'd be great. Thank you.
Great. Thanks, Jake. Chris, do you want to take the first one?
Yeah, first question from Gary. Thank you very much, Gary. Question was, what drove the decision to implement the buyback at this stage, and how to balance this with other potential uses of capital, such as organic growth or M&A opportunities? So I think there's a couple of 3 points I'd make on that one. One, I talked earlier about the tram lines that we have, the 8 to 12% of annualized revenue. So that's how we see our definition of the amount of cash we should have. At year end, we were 9%. So our average month end cash of 155 million is just about 9% of our revenue of 1.77 billion. So we were comfortably within our tram lines. If you take that position, then you consider how strong our cash conversion was during the period. We took those profits, as I say, of about 30 million and turned it into operating cash flow of about 30 million as well. So we have strong cash flow. So when we received the cash refund for the corporation tax, our view was, well, that feels one time in nature. It feels like something that we should have returned to shareholders some period of time ago. We were comfortably in our tram lines, bearing in mind that 9% of 1.8 billion of revenue is a much bigger number than 9% of our previous revenue of 1.4 billion. So we were comfortably in that. And our view is, in reality, if we continue with our strong, robust risk framework and strong operational framework, we will generate the sort of same 10 million in about 5 or 6 months. So by the half year, we would have generated that cash anyway. So our view was it felt like excess cash. As we have in the past, we've done special dividends and share buybacks. Our view was this time the share buyback made more sense. It builds more strength in the balance sheet, more firepower in the balance sheet. Should we ever wish to do a bigger M&A and we needed to issue share capital, over the last 2 share buybacks, we'll have bought back about 10% of the share capital, 7% last time on a share price that was sort of circa 170, 3% this time on a share price of about £3. So our view is balance sheet's in great shape. This felt one time we were comfortably within our tram lines, and we feel like we're going to continue to generate cash. We're working on acquisitions. You'll see we've done 4, so we have a good track record of that. All acquisitions will be considered in the light of our strategic hurdles, and Bill's talked about where the targets are going and hitting the higher margins. So we're not going to chase revenue, we're not going to chase volume, we don't need to do that. So it needs to pass the strategic hurdle, and then of course it needs to pass the capital allocation hurdle. Does it make accretive returns to us? If it doesn't, we shouldn't spend our money there. So we've got a very clear view of capital allocation, a very clear view of when and where we'll do acquisitions. And so if you consider all of those elements, the share buyback made the most sense at this point in time, and that's why we put it out there. Bill, back to you.
Thanks, Chris. I'll just add as well there that it's quite a strange market out there at the moment. Our acquisitions, as Chris said, are likely to be bolt-ons, and there's a bit of a rush for the door for the end of October going on at the moment. So we're not going to be pushed in terms of a time limitation on due diligence. So I think we'll just let the dust settle and go back in when common sense returns. Right. So Rob, question, Rob. You referenced you had 92% of full year 25 revenue already secured. Yes. Could you provide some more color on the sectors and the visibility beyond 25 and how you're managing any potential risks in these contracts? Can I go back to that slide? So Rob, you can see the sectors there. So the biggest sector, by some is environment, which is water, at £905 million, and then highways at 640. And then most of the building ones are fairly close, I suppose. Education, 634, defence, 437, custodial, I can't read the number, 329. The interesting one there, and then commercial, 483. You'll see the FM order book there at 324 million. That's a sort of long, slow burn order book. All their projects are sort of 10 years in duration, so that's quite a lot slow burn order book. The visibility beyond 25, if I go to the framework slide there, we've got great visibility beyond 25 through the framework. So we might not know exactly which school we're going to be building starting, well, in 25 we probably will know now, by the way, but in 26, 27, but we will know based on the geographical presence we have around the country and where the schools are. We will know that we're likely to be building a few schools here or there. I mean, typically we're building something like 35 schools somewhere in the country in some stage of their evolution at any time, for example. So we get really good visibility through a long way into the future, and actually in water we visibility years into the future. And then your comment about managing risk on these contracts, bear in mind that whilst these frameworks last for 5 years, we price every project on its own merits at the time. So if we're pricing something now, we're looking at inflation now, we're looking at risk now, and if we're pricing something in 2026 or 7, we'd be doing the same thing. So everything we do is priced on current pricing, and so all we're ever looking at really through the tenets of our projects for inflation, for example, is a differentiation between, or the difference between what we thought would happen to inflation and what's actually happening, and we're normally pretty accurate in that. So I hope that answers that one. Then David S. As you shift from AMP7 to the larger AMP8 water plan, what measures are being taken to ensure a smooth transition and capitalise on the opportunities in this new phase? Well, I tell you, in my entire career, we've been trying to get the regulator and the water companies to stop the sort of hiatuses between amps. And to be fair, we've made steady progress over the amps. And so far, as I said a minute ago, so far this year is the smoothest I've ever seen. Now, there's still some way to go, of course, but there's such an enormous backlog of work that the regulators are allowing the companies to sort of merge AMP7 and AMP8 better, to start AMP8 earlier, and things like that. So it is important for us that to keep those sort of resource histograms as level as we can. With regard to opportunities, well, you know, the AMP is doubling pretty much from 57 to 88 is the latest number. I think it'll go up a bit. But the amount of work out there is enormous. The important thing for us is that we're not going to bite off more than we can chew. We'll work within the constraints of good people and good suppliers and so on. Biting off more than you can choose is normally ends up regretting it later on. So there's a big opportunity out there, but we will be sensible. We will grow strongly in water, but we won't double, that's for sure. I hope that answers that question. Then one from Nicholas. The FM business is positioned as a complementary offering within the building segment. Are there plans to scale this further or expand the FM business into new regions or sectors? Yeah, the FM business is a good business. It's mainly looking after the fabric. So we do hard FM only. We don't do soft FM. We don't do cleaning or cooking or stuff like that. It is complementary. We can allow. So the first thing is, what we mainly do now is look after assets we've built in the past. How do we scale that up? Well, there's a few things we can do. We can offer everything we build. We can offer FM service to our clients, and we do. In many cases, if you're the DFE or something, they already have frameworks for FM, so it's quite hard to get in. We do some, but there's opportunity for growth as the frameworks come up for renewal. We offer commercial clients opportunities for sort of soft landings. So in other words, we do the construction for whatever it takes 2 years, and then we'll look after the building for 2 or 3 years after that to just get into steady state. And sometimes that leads to a longer term contract, and sometimes not. But the biggest opportunity, I think, in FM, the hard part of FM, of course, is the fact that there's lots of PFI portfolios that are coming to maturity recently and over the next few years, as the sort of typical 25-year period. If you think back to the old PFI days, they all coming to conclusion. So there are packages of work that have been managed by concession companies that are going to come back onto the market in the next few years, and we understand that market because we played in it, of course, and so we feel well placed to pick up some more FM work as that evolves, as those packages get handed back. So I hope that answers that question, Nicholas. Peter, can you expand more on your risk management strategy for contract selection? Let me go back to that slide. This one. So we have what we call a heat map. I need to keep this relatively high level, I suppose. And the heat map at its highest level says, who is the client? Have they got sensible terms and conditions? Can they pay? Do we have the people? Do we have the supply chain? Is it in the right geography? Now, you might think geography is a funny thing to say in the UK, but for example, I've got nothing against the middle of Wales, but we don't have any presence in the middle of Wales. So if someone said to us, can you go and build something in the middle of Wales, we'd probably say no. You know, we're not the best placed people. There'd be better placed contractors for us. We don't have a supply chain there. We don't have people there. So geography does come into it occasionally. So at a high level, we have this heat map. And if any one of those triggers goes red, regardless of the size of the project, then it'll come up to the exec for a discussion about should we or shouldn't we be doing this job. Everything above 25 million comes to the exec for a discussion, even if it's got no red flags. And sometimes it's quite a short discussion. You know, if it's a very standard school in a very standard geography, and we've done, you know, we do them all the time, then it's going to be a fairly short discussion. And occasionally something comes through, Peter, where on the face of it, the project doesn't look very good. So I won't mention the client, but one came through a few years back now, which was glowing red, and we couldn't really understand why the management team brought it to us. And they said, well, it's such a cracking job, but you know, the terms and conditions are unacceptable. And what we did in that case, we went back to the client and we said, look, it's a nice job in principle, but your terms and conditions are unacceptable. If you change these things and be more sensible about it, then we'll bid it. And to their credit, they did. They changed. They heard us. They changed the terms and conditions, and we bid it. And in that particular instance, we came second actually and didn't win the job. But the point is that the risk management process works. So we do those sorts of things at a very high level. That's what we look at, Peter. And your second question was about adapting to labour market challenges. Well, we've always been a real working wage or real living wage employer, London living wage employer. And so, yes, the sort of ripple effect of a minimum wage will ripple up a bit. But going back to what I said earlier on is that we price everything on current numbers means that, there's a very narrow slither of impact there, and it's not going to be significant at all to us. In terms of the changes to the broader labour market, in terms of sick pay from day one and all of those things, we pretty much do most of that already, and I don't anticipate a huge impact. 99.9% of people are sensible, and a tiny minority will try to take advantage of it, and you've just got to brush that off and move on. Really, is my view. So I don't think there's going to be much of an impact on our business there.
Bill.
So those are all the questions I can see, Jake.
Absolutely, Bill. Chris, if I may just jump back in there, thank you very much indeed for being so generous of your time then addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll of course make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses where it's appropriate to do so. And we'll publish all those responses out on the platform. But Bill, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Yeah, thanks, Jake. I think, in summary, we're in really good shape. As I said before, great bunch of people, very strong order book, very strong balance sheet, and the outlook is phenomenal. Actually, we've got great positions in water, in roads, in defence, in education, in justice. Those are the big markets, health, etc. And our ability to augment those construction margins through the higher margin specialist businesses is going to be the exciting bit of the next few years, to continue to grow the big ones and grow the margins, but grow the specialists faster and add grist to the mill and improve our margins through that route, as well as, of course, getting back into the affordable housing market. So we're very well set, and I think stability in government, regardless of political views, will be good for the company. And just as an aside, by the way, Labour governments historically have always been better for the construction industry than Conservative governments. And I think if the Chancellor does get a bit more headroom in terms of capital spending to invest, that will do our industry good as well. So overall, I'm very positive about the future. There's lots of noise out there, but as far as our business is concerned, and I think for the broader construction industry, the outlook is very positive over the next decade and more. Thank you very much for joining. Really appreciate it. Take care.
Perfect. That's great. Bill, Chris, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Galliford Try Holdings PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.